Let me introduce you to Sabina. Sabina wrote into the Financial Post. She's 58 years old, plans to retire at age 60, and her question was, when should she start her CPP, age 60 or 65? Now, has $600,000 of investments, split evenly between a non-registered account and RRSPs, and she's spending $18,000 a year on a rental apartment. Her lifestyle expenses are about $32,000 a year, so she's looking for about $50,000 a year after tax in retirement. And I'm sure she's thinking, she has $600,000. If she gets 5% interest, that's $30,000 a year. Plus CPP, OAS, that's another $20,000. That's her $50,000 a year. But when I run the numbers, she's running out of money at about age 80. Okay, so what's happening? Taxes and inflation. Let me show you. If we look at how much taxes she's going to pay between now and age 90, it's about $145,000. Let's look at inflation. So I'm showing here 2% inflation. Let's stop inflating that expense. And we can see here, in terms of her investments, she's now got plenty of money. Okay, so let's inflate it again so we can see that. And when we do that, we can see 2% inflation has robbed her of more than 10 years of retirement income. Let's get back to her questions. When should she take CPP? So on this side, she's taking CPP at 60 and over here at 65. And just looking at the graphs, it looks about the same. So let's drill down a little bit. And we can see in terms of total investments by about 2044, so when she's age 80, she doesn't have much left, okay? So let's take a look and see what happens if she draws at age 70. And we can see that actually she has a bit more money. The money's lasting longer over here if she takes it at age 60, okay? But we need to look at something else. We need to look at her income. So let's take a look at the income. And when we look at income, again, looking across here, 2047, when she's age 84, there's about a $6,500 difference going down. So let's take a look too and just see what happens when we drew at 65. But if I come across and look at the income here, there's only maybe about a $3,000 difference between the two. Now you might be wondering why there wasn't that much difference. Well, here's the difference: the guaranteed income supplement. If I just look at Canada Pension Plan, there's about almost a $7,000 difference in terms of Canada Pension Plan. But when you take CPP early, Sabina spent all of her money, she's going to receive more of the guaranteed income supplement. So that makes up some of the difference. Okay, so let me show you one other solution that we tried. So what we did is Sabina drew money from her RSP, about $20,000 to age 63, and then stopped, and then drew from her non-registered investments. And in doing that, she was able to collect the guaranteed income supplement from 65 to about age 70. And then we delayed, of course, CPP to age 70 also. So let's take a look at that. So on this side, what we've done is we've drawn from the RSPs here, delayed the RSPs, and then we drew heavily on the non-registered investments. On this side, we drew evenly. Okay, so this is the RSP coming down, the non-registered, so they're both gone here by about age 80. Okay, so that's the difference in terms of how we drew the money. And then let's take a look, see how much is left here. Okay, so we can see here 2043, there's quite a bit more money left of drawing RSP early, delaying, and then not taking any between 64 and 70. So those are a few options for Sabina to consider. And it really depends what she's going to do to try to fill this gap. If she is going to, do some part-time work or something, then collecting the guaranteed income supplement's not going to work. But delaying to age 70 does give her a higher income later in life once the money has run out.